Hit it.
It's Friday, August 23rd, 2024, episode 246. I'm Patrick Ceresna.
And I'm Kevin Muir. This week, we welcome back to the show Louis-Vincent Gave from Gavekal Research. We have a fascinating discussion about the differences of Chinese capital markets versus the West, why gold is in a structural bull market, and the difficulties of investing in the current environment. Then Patrick breaks out the Crayolas and draws some squiggly lines to help us make sense of the markets in talking charts.
A quick shout out to all the listeners that popped by the Market Huddle Piss Up. It was so great to meet so many of you. Now, for those of you that missed out but still want to chat with us, Kevin and I decided we're going to host a live Q&A on YouTube on Tuesday, September 3rd at 1 p.m. Eastern Standard Time. The link for that YouTube Q&A will be in the description of the episode, and we will also be posting a link on X. So, folks, stick around. We're going to drink some beers here. Danny, what beer am I drinking this week?
You are drinking Steam Whistle Pilsner. This is a European-style lager that has grown to be Canada's #1 craft beer. Is that true?
You know, they're trying to brand themselves sort of like the way Heineken did, right? They use only I think 4 different ingredients, and they have like the big kind of tourist tour that they provide all the way by the CN Tower. So they're trying to really brand themselves as that nice crisp beer. It's actually really good though. It is a good beer. I like it.
All right, let me do the actual disclaimer. Nothing in this podcast should be viewed as investment advice. Listeners should consult an investment professional before making any decisions regarding topics mentioned in this show. Side effects of too much huddle may include the yield curve yawn, the volatility of vertigo, or the inflation insomnia.
I suffered the vertigo for sure. Let's get Louis on.
It's our great pleasure to welcome back to the show Louis-Vincent Gave from Gavekal. Thanks for coming, Louis.
Thanks for having me. It's been a while, and I'm so happy to be here.
It has been a while, and it's going to be a lot of fun. And before we start, let's actually talk about a little bit about the Olympics. You are, of course, French and from France, like no true French. And you went back. What was it like? What were your impressions? Like, did you enjoy yourself?
I did enjoy myself, and I actually wrote a piece while I was there telling everyone, if you have spare time, come over. This is as good as you'll ever find Paris. There was nobody there. You had the place to yourself. You could go into any restaurant, and you were treated like a king, which is pretty unusual in the summer in Paris. They were the only people in Paris were the cops, and of course, the families of the Olympians. But you basically had the city to yourself, and the events were super. It was very well organized. It ran very well. And all the Parisians had left fearing it would be chaos, and it wasn't. And I think foreigners stayed away because you may remember that last summer we had pretty bad riots in Paris.
Right.
Even for us, they were pretty bad.
Okay.
On a scale of 1 to 10, they were a 10. So putting it all together, it was, usually these types of events are terrible because they're too crowded. This wasn't the case. It was awesome.
It's one of those things that we used to drive to the cottage out of Toronto, and everyone would leave at like noon or the day before, and no one would want to leave at 4:00, like after the market closed on Friday, because they thought it would be so busy. And it was ended up being that oftentimes that was the best time to go.
Exactly. That's exactly what the Olympics were like.
It was so efficient that it was actually arbed out. All right, let's talk about arbing stuff. Let's chat about the markets. I put together a couple of slides here in terms of your presentations that you have recently. Let's start with gold, because although it is hitting new highs, it has been a terrific investment. I don't know about you, but I've been shocked about how few people have talked about it. It's just one of these things that, it's a bull market that no one cares about.
It's a bull market. Absolutely. It's a bull market no one cares about. It's a bull market that is, sort of in a vacuum right now. If you're looking around the world, there's only 2 asset classes making new all-time highs as we speak. One of them is gold, and the other is Chinese government bonds priced in US dollars. That's it. So if you're looking for things that are breaking out to new highs, that's basically it. And I think we all know the reasons why it's breaking out to new highs. It's breaking out to new highs because of the sanctions that were put on Ukraine in 2022. the fact that central banks around the world now no longer feel as comfortable owning US treasuries, the fact that, frankly, US fiscal and monetary policy has been out of whack for, I would argue, since before COVID, but COVID made everything worse. Um, and it's a bull market because at the end of the day, still very few people own this. And then there's another reason it's a bull market, the one that most people forget. And it's a super important reason, is that gold, more often than not, is actually a derivative play on emerging markets.
Oh, okay.
The buyer of physical gold in the world is not a guy sitting in Toronto or a guy sitting in New York. It's a guy sitting in Hong Kong, a guy sitting in Riyadh, or a guy sitting in Mumbai. Roughly 2/3 of the physical demand for gold comes out of India and China. And so when those parts of the world are doing well, gold tends to do well. Now, today, India's obviously been booming. It's been a roaring bull market. The economy's doing great. India's on a terrific dynamic. Now, you could argue, while India's in a terrific dynamic, China's on a crappy dynamic.
Right.
China had, the balance sheet recession to end all balance sheet recessions. Real estate has gone down a third. Stock prices have gone down 2/3. Imagine if this occurred in the US. The economy would be one big black hole. There'd be no car sales, no restaurant sales, nothing. But here you've had massive balance sheet recession in China. And one of the reasons the economy has not imploded is that Chinese exports have absolutely soared. Now, this is something that I think people are not spending enough time on, but China's trade surplus today is $100 billion a month. I mean, this is gargantuan. This is bigger than Japan's biggest trade surplus added to Germany's biggest trade surplus. It's nobody's run trade surpluses before like China. Usually, you would think that with that, the renminbi should go up and the Chinese asset prices should go up. But I think the guys on the other side, the guys earning that 100 billion a month, have zero confidence in their own economy for a number of reasons that we can discuss. And the path of least resistance for them is to recycle all that money into gold. It's going up, it's got momentum, and they can physically, own it, hide it in their back garden. So all this to say, you get big demand from China, big demand from India. Gold prices moving higher. It's a bull market.
Right. So in terms of the Chinese market, one of the things that you mentioned there was the fact that it's not just the central bank; it's also the actual private sector players. And you highlighted the fact that they're running these huge trade surpluses, and yet much of Wall Street and the West is kind of ignoring that. And is that partly because those trade surpluses have changed in terms of who China is running with?
Yeah, I think that's part of it. If you look at China's trade surplus vis-a-vis the emerging world is now bigger than China's trade surplus vis-a-vis the whole developing world.
Oh, wow.
So there's been a dramatic shift in the composition of China's trade in the past 5 years. And I know you and I have talked about this before, but out of nowhere in the past 5 years, China is now the biggest car exporter in the world. Now, when I tell this to Americans, they're like, no, they're not. Like, there's no Chinese cars on my streets. Um, and you say, okay, sure. Now, go visit Sao Paulo, go visit Riyadh, uh, and you'll see a lot of Chinese cars that just weren't there 5 years ago. Um, and you can make the same story for nuclear power plants, for solar panels, for turbines, you name it. China is now exporting it, and very often, again, exporting it now to other emerging markets.
Right.
Now, the big question mark for me is this today: is when I look at China's 100 billion trade surplus, that's a huge anomaly monthly. This isn't per year, to be very clear.
Yeah.
100 billion a month. I mean, this is enormous amounts of money. You look at this and you're like, this really isn't sustainable. It can't last. I think for now, what's happening is the guys on the other side of it, the guys making the cars, making the turbines, making the solar panels, they get that money. And while in the old days, they would have turned that money into the PBOC, who would have then gone out and bought US treasuries. More often than not, they try their best to keep that money out of China. So they book their sales through Hong Kong, they book their sales through Caymans, through Bermuda, through wherever. They have intellectual property billings from these other jurisdictions. Keep that money abroad, and from there, I think the money basically has been going into wherever had positive momentum. Because at the end of the day, Chinese investors are momentum investors. Whatever goes up, they buy. So gold goes up, you buy that. Microsoft goes up, you buy that.
So do you
And
think that they're long a lot of the Mag 7? Like, do you think that that would be something that the private Chinese accumulators of capital are overweight?
well, I would put it somewhat differently. I think they're long the US dollar, right?
Okay.
Through a lot of this trade, they earn a lot of US dollars. Now, if you're long a lot of US dollars today, what'd you do with them? Do you buy US treasuries? When the federal government is issuing an additional 2 trillion a year, um, when they've delivered negative returns for the past 3 or 4 years. Uh, I mean, if you're long US dollars, you really have three options. You keep them in cash. Oh, sorry, four options. You buy gold, you keep them in cash, you buy stocks, or you buy bonds. In the past, I think there was a lot of bond buying done mostly by the PBOC. I don't think that's happening today. So yeah, I do think they do buy stocks. And if you're going to buy stocks in the US, if you're a foreigner buying stock in the US, what's the point of buying John Deere or buying Caterpillar?
Yeah.
You know, you have this back at home and you have it at a fraction of the valuation. The one reason, if you're a foreigner, you're buying stocks in the US is to buy stuff you don't have at home. And
Ah,
what you don't have at home, it is the Max 7, for better or for worse.
that's fascinating. Now, just quickly back to the cars. We have talked about it, and I was telling you the story of how when I went to the Grand Caymans, and
Yeah.
I got there and I thought I was renting like a Kia or something like a Hyundai. And I get there and they hand me this other thing. I can't even remember the name of it. And I'm like, what is this car? And it's some sort of it's not an EV, it's an actual like ICE, like an internal combustion engine. And I get there and I get to my, the nice fellow was hosting me, and it's this fancy place that he's staying at. And he says, "Oh, you have one of these, you have one of these cars." And he says, "This thing is taking over the island. Everyone wants one." And it's it's like half to two-thirds the price of like an American Ford. And sure enough, I watched this and it was just everywhere. Like this car went, and I think that nobody had these 5 years ago, and now it's like half the island owns them.
But wait, aren't you worried that deep in the entrails of the Chinese Communist Party, there's now a file on Kevin Weir with all of your traveling habits?
One of the things I love best about you is when you chat about the fact that people say that the Chinese renminbi is overpriced and has to collapse because the economy is about to collapse, and you tell them what's the line?
Wait, hold on, time out,
Yeah,
time out.
yeah,
You just told me about the Chinese car that's half the price from all
exactly.
the other cars, and now you're telling me that
I'm
it should
not
be a
telling
quarter
you.
of the price?
Kyle Bass and the boys are telling you.
Okay, okay.
So what's the line you tell them? Like you tell them to go buy a car in China for $10,000 or go stay at the Four Seasons.
Exactly. I mean, look, for all the talk out there that, the renminbi needs to devalue, you got to stay at the Four Seasons in Shanghai today or in Beijing, you're going to pay $200 a night and you're going to get impeccable service. This isn't the China of 20 years ago. You're going to walk in there, people are going to speak English perfectly. You're going to have some of the best meals that you've had in your life. All this for a fraction of the cost. Now, we were just talking about Paris. Perhaps one of the reasons people didn't show up in Paris is if you want to stay at the Charles V, the Four Seasons in Paris, that was 2,500 euros a night.
Wow.
So we're not talking on the same scale here.
Right.
Um, and as much as I think Parisians are the most lovely people in the world, I'm not even sure you'd have as good a service in Paris as you would have in China. So you know, today you can take a high-speed train from Beijing to Shanghai, which is roughly the same distance as New York to Chicago. Okay,
Okay.
if you want to go New York Chicago by train, it's going to cost you $270, and it's going to take you 17 hours. You want to go Beijing, Shanghai, roughly the same distance. It's going to take you 5 hours and it's going to cost you $80. So, for all the talk about how China needs to devalue, I think it's frankly from people who haven't visited China in at least 5 years. And in fairness, most people haven't because, COVID hits in 2020, China completely locks down, and it's basically impossible to visit for 3 years. Then once China reopens, by then you have the Russia-Ukraine war, and China's on the side of Russia. So by then everybody has decided China's uninvestable. I'm not going to even waste my time to go over there. It's a terrible place with a terrible regime. Xi Jinping is the only worse guy than Xi Jinping is Putin. I'm not going to waste my time.
Right.
And so that becomes the mantra. So nobody's been there in 5 years. And so what people have missed over the past 5 years is the massive productivity gains that you've witnessed in China over that period. Whether it be from fintech, like we like to think we're all advanced on financial services on with apps on our phone. We're years behind where these guys are, years behind. On e-commerce, where I'll just give you an example. When I was last in Beijing, I stupidly forgot my computer charging cable at my hotel in Shanghai just before. So I'm in Beijing, and I tell my sales girl, I say, look, can we stop by an electronics store? I need to buy a computer cable. She said, I'll just order one. It'll be in the office by the time we get there. It'll be faster. And she does. She just went online. Boom, we got to the office. The cable was already there.
Wow.
That was like an hour and a half later.
Right.
So the point I'm making, and then you can go into cars that are half the price, the rail system that's world class, et cetera, et cetera. And so the idea that China needs to devalue would seem so crazy to anybody who spent any time there.
Right.
So for me, anybody who bangs on about how China needs to devalue is someone who's like, I immediately ask them, when was the last time you were there?
Right.
And invariably, the answer is somewhere between I've never been there to before COVID.
Right. The other thing, though, that you kind of briefly touched upon there was the fact that China is no longer just making T-shirts. They
Yes.
are gone up the value scale of what they're producing. Could you talk a little bit about that?
Well, look, producing cars, producing nuclear power plants. For me, a sort of painful moment was when I realized that France was bidding. So Saudi Arabia's put out tenders to build nuclear power plants. France comes into bid, and that's the kind of business that, as a Frenchman, I expect us to win.
Okay.
Building nuclear power plants is what we do,
Right.
and it's complicated work. It takes lots of high-end engineers. You don't invent yourself a nuclear power plant manufacturer overnight. And in comes China and bids at a third of the price that the French companies are bidding at.
And do you trust that? Like, you think it's a third of the price, but it's also like you're comfortable with that?
Well, let's put it this way: China's gone in the past 30 years from 2 nuclear power plants to 55, and they haven't had any accidents.
Right.
And they're going to go from 55 to 150 over the next 10 years. The reality, in fact, yeah, I do trust them because they've built more power plants than anybody else in the past 10 years by a factor of 20.
Yeah, that's true.
And the more you do something, the better you get at it.
Right.
I mean, typically, although I don't know, the more I invest, the worse I seem to be getting.
And I guess one comparison you might say is, like, my dad tells a story of when Japanese cars first came to Canada. They were they'd literally taken motorcycle engines and put them in a car, and they were like chain drive, like Honda Civics and stuff, and they weren't used to salt on the road, and they just corroded away. And now you kind of look at those crap cars that nobody wanted, and they're the best cars like on the road in terms of for like reliability and just great price and stuff like that. So we've seen this story before.
So we have, but I would say that inherently, I think when we look at China, we sort of have a coping mechanism. We, being the Western world, have a sort of coping mechanism. We say, yeah, you know what? These guys can copy what we do, but they can't innovate.
Okay.
And I mean, that's our coping mechanism, right? They're not creative. They're just an army of robots, and they can. And then in we come, and this week, China releases a video game that's the most successful video game in history. And the Monkey God video. Yeah, I don't play video games, but
I don't know either.
yeah, it's like that Monkey God video game
But
thing.
you sent me a video the other day of like they literally made a flying car.
Yeah, they're flying cars. No, the best is the BYD amphibious car.
Okay, I haven't
yeah.
seen that. They made an amphibious car.
Yeah.
But Musk talks about it, but they actually did it.
No, BYD is today that Xpeng flying car is sort of prototype, and
Yeah.
it's cool looking, but it's not. But the amphibious car, you can go today and buy your amphibious car from BYD, and in Dubai they're selling like hotcakes because Dubai has grown so fast that their sort of water management system hasn't kept up, and we saw this year, right?
Yeah.
Big rains, all of a sudden floods everywhere,
Yeah.
and so now everybody's
We're going to need amphibious cars in Toronto these days.
yeah, everybody's buying amphibious. So BYD sells these amphibious cars for $100,000. Check it out on YouTube. They're kind of cool.
Oh, I had no idea. It's like James Bond.
Yeah, yeah.
So, but yet, okay. So I hear the positive story. Yet when we look at the stock market, when we look at their real estate market, it's hard to disagree that that they've had some troubles. So
Oh,
let's
for sure.
talk a little bit about what's going on there. And is this an opportunity or is it just going to continue? And I talked to you and I said before we were recording, I said, it looks to me like they're making the same mistake that Japan made and that Europe made of, in essence, trying to fix everything with monetary policy, not doing enough fiscal. And it looks like they're stuck in a balance sheet recession, the Richard Koo thing. And you said, no, they're not. Explain to me why they're not and why China might be, and this might be an investment opportunity as opposed to a problem.
So I think it is different than Japan. To begin with, I think the sources of the problem are the same. Japan had a real estate bubble and China's had a real estate bubble, and dealing with those hangovers are never easy. But the scale of the Japanese real estate bubble was like nothing we've ever seen before or since. You had a shop in Ginza that sold for $1 million a square foot. You remember the stories where the Japanese Imperial Palace was valued at more than the whole of California.
Right.
Uh, it like Japan got to level of silliness that were absolutely so extreme that by the time you got to the top bit of the bubble, everybody in Japan was doing real estate. Like, you might be a widget manufacturer, you might be a car manufacturer, but really you were in the real estate game, and you were like borrowing money to do real estate, etc. So when real estate imploded, obviously the bank balance sheets imploded, but actually everybody's balance sheet imploded. Now, the reality in China, we've had a real estate bubble, and the government cracked down to prevent it from going to Japanese levels. But it never got to the point where every business was just doing real estate. Alibaba, I know the Alibaba share price is down 80% and Tencent. They didn't go down because real estate was going down. These guys weren't doing real estate. They were doing e-commerce or they were doing fintech. And so the negative drag from real estate is there in China, but it's not going to be a 20-year thing like it was in Japan. So that's the first point. Now, the second point is, you just said, well, they should be doing more fiscal, they should be doing perhaps more monetary policy, and here I think this is where things get very interesting, because as a policymaker, what do you think your role is? Is your role to be a referee? Like in a hockey game, you try to be as you set the rules, and then you try to apply the rules as fairly as you can, without favoring somebody or other. Or is it a case, or are you a referee of a 5-year-old soccer game where if there's one team that's absolutely crushing the other team, you try to lean in a little bit with the team that's getting crushed, because at the end of the day, it's 5-year-old soccer, and it's 5-year-old soccer, and you don't want so is the government's job to lean one way or the other? Because what you've had in China is you had property developers that lean far too far above their skis,
Okay.
that got way overexposed, and then they implode. So is it now the government's job to come in to ride to the rescue of the overlevered property developers? Is it, you would say yes, if the problems of the Chinese property developers is going to create a systemic crisis, collapse the banks, and from there collapse the economy.
Right.
Now, let me ask you a question. How much are Chinese banks up in the past 12 months, the share prices?
I don't know. I don't actually follow Chinese banks.
They're up 40% in the past 12 months.
Oh,
They're
so
amongst
they're doing fine.
they're amongst the best performing banks in the world. So you have a real estate bust. And every Westerner is screaming, "Oh, the Chinese government should help the property developers. The Chinese government should help." But why? But
Right.
why?
It
These
feels to
guys,
me when you're describing this, it feels very much like the difference in banking in America in the 2008 crisis versus Iceland.
yes,
Remember in Iceland, they
absolutely.
right? They said to
Let
the
it burn.
banks, let it burn. And so so your argument is they are doing this in real estate, and that ultimately is going to make the system much more efficient. Is that correct?
It is. And the one thing to understand is the property developers, are not well liked by the population. It's not like a property developer could run and win the presidency in China. That's not going to happen. They're not well liked by the population, and they're definitely loathed by the policymakers. So these guys hitting the wall, you know, nobody's running around the halls of power in Beijing saying, "Oh my God, these guys are hurting. How do we help them?" Instead, it's like, "Oh, good. They liquidate their stock, real estate prices come down, it becomes more affordable for the next guy." Now, you could say, yeah, sure, becomes more affordable for young people, but for the older people who bought real estate at a high price, they get screwed.
Right.
Uh, and I would say, yep, yep. So, what's better? Because at the end of the day, economics is, it's the dismal science. It's the science of scarcity. Is it better that we screw young people and make real estate unaffordable
Right.
so that the older people, get to fart in silk, and live comfortably, or is it better the other way around? Now,
No,
the
you're absolutely,
reality
yeah,
in
you're
the Western world, this is what we picked, right? We had real estate go down, we had bank problems. Like, oh my God forbid the boomers lose money. You know,
right.
God forbid the boomers might not be able to buy a second yacht when they retire in Florida at 65. Um, and if that means screwing over the 20-year-olds, then so be it. Let's screw over the 20-year-olds.
Right.
And that's exactly what we've done. Now, I sent you my piece on the permanent portfolio. Um, if you think of the world as having four major asset classes, you think bonds, equities, gold, and cash. All
Okay.
right. Those are your four main asset classes. If you look at the past 10 years, what you've seen in the US is equities have 3x'd, gold has gone up 60%, and bonds and cash have been crushed. In real terms, it's been a disaster.
Right.
So what policymakers decided in the US is they decided, you know what? We're going to screw over the bondholder and screw over the cash holders for the benefit of the equity holders. And and so be it. And that's what they did. If you look at China, you look at these four things in the past 10 years, over 10 years, in real terms, all four make money, which is how capitalism should work. You shouldn't be favoring equity holders over bond holders or gold over cash. Ideally, all four make money. And if you had a quarter, a fourth, a fourth, a fourth, a fourth, in the US, you return 3% real. If you had a fourth, a fourth, a fourth in China, you return 5% real. Now, the reality, the big difference, you could say, between China and the US is in China, 10% of people own equities and 100% of people own cash, and indirectly 70% through their pension funds, etc., own bonds.
Okay.
Now, in the US, you could say it's reversed, 70% own equities. So, but a lot of, and 100% own cash. But the whole Western view of, oh, China should stimulate more is in essence saying China should screw over the 100% who own cash to benefit the 10% who own equities. And, where's the justice in that?
No, you're absolutely right. You make good points. All right. Someone else who makes some good points is Russell Napier. He argues that over the long run, the value of Chinese equities are zero for a Western holder. Oh, by the way, Louis has gotten into the spirit of Market Huddle, and he is definitely drinking. And Louis, although he is French, he has moved to Canada. And so, what are you drinking?
So you know what, Kev. I'm more amenable to people like you. I don't. I'm not into the fancy schmancy beers like our friend Patrick. So I'm drinking a Molson Canadian lager, and Patrick at this point is probably spitting out his dummy.
That's
But, but But here you go.
Um,
A plain lager bought by the case.
There we go. I love it. So now back to Russell Napier. He thinks that the value of Chinese equities for Western holders is zero. I understand his
I'm
argument.
definitely a buyer at zero. If he sells them there, I'm a huge buyer.
That's a good line, Louis. You're making me laugh, though. That's a great line. So why don't I first of all, one of the things that a paradox that you highlighted that I thought was the most brilliant thing of the year was people that would say, I can't buy China because it's uninvestable because they're going to invade Taiwan. And then you highlighted something else that they all owned and you said, that makes no sense. Can you tell the story?
Yeah, no, absolutely. No, this goes back into shortly after the Russian invasion, when the general media loves a scare story, right? So you look around the world, it's like, oh, there's a war here. Where's the next war? The next war is going to be China invading Taiwan, and that became the prevalent belief amongst most asset allocators in the world. And so invariably, I'd go to them and I'd say, okay, I get you don't want to buy China because China's about to invade Taiwan, but do you own Nvidia? And they say, of course I own Nvidia. Number goes up. Yeah, of course. Why wouldn't you own Nvidia? And the answer is, well, you wouldn't want to own Nvidia if you really believe China's going to invade Taiwan. For the record, I do not believe China's going to invade Taiwan for a number of reasons. If you want, we can go down that wormhole. But all of Nvidia's production is done by TSMC. So if tomorrow China invades Taiwan, TSMC becomes a hole in the ground. And what's the value of a chip company that can't produce chips?
Yeah.
I don't know what it is, but I'm pretty sure it's not $3 trillion.
Right. It's shocking to me that you had these two narratives that were so obviously opposed, and yet nobody sat and saw the kind of the irony of the two prices and the two narratives.
Look, I think by the time you're buying a stock at 30 times sales or 70 times earnings, a stock that is a deeply, deeply cyclical stock, a stock that in its own history has gone down 80% plus like 3 times in the past decade or something.
Yeah.
By the time you're buying that stock, I think you're doing it more for career protection reasons than anything else. You're doing it because not owning it is just too painful.
Right.
It's not because you think, Nvidia is going to go from 3 trillion to 10 trillion market cap. You're doing it because if it goes from 3 trillion to 4 trillion, you're going to get fired. And some of the biggest mistakes in our business have been done out of a fear, basically for career protection reasons.
Right.
It's I got to own this because otherwise I lose my job.
Right.
And by the way, by the time you do something for that reason, that should be the warning bell that you shouldn't do it.
That's right. All right. So let's go back though to your point that you said China has chosen to not put the equity holders ahead of the rest of them. Yep. And in doing so, what we had was a brutal bear market in Chinese equities. Does this preclude China equities from being good investments, or has it just basically let the air out of the kind of the balloon and it's now like sitting there and it's easy to pick up? Or like, I don't know what a good analogy is, but is it so cheap that you just almost can't own it? And one last thing, back to your thing about you can't own China. All you have to do is look at EEM, that includes China, and then EMXC, which is EMX China, and look at the two asset growth, and you can see how much people have avoided China. Does that change? Like, or is China going to go up on its own for other reasons?
So lots of questions, all excellent ones. I'll start off by saying, when I started in this business, I often tell this story, but our very first client was a gentleman called Beat Knotts, who ran Notch-Juki in Geneva. Yeah. And he said, Louis, it's an easy business. When you don't know what to do, when the whole world's falling apart, remember that the Fed will always manage the economy for the benefit of the equity holder. And the Bundesbank, I'm showing my age, the Bundesbank will always manage the economy for the benefit of the bondholders. Okay. So if you don't know what to do, you buy German bonds, you buy US equities. And in fairness, if I'd followed that advice, I'd be richer today. But there is no more Bundesbank.
Yeah.
And I would argue there's not even much of a Bund market. The new Bundesbank is the PBOC. And the reason the Bundesbank is the PBOC is because if you're China, your number one policy priority, imagine you're Xi Jinping. Before you put on your pants in the morning, your number one concern is, how can I de-dollarize my economy? For very simple.
You think that's what like is really driving him? Like,
no doubt about it. Look, he's had US policymakers from both the left and the right over the past 10 years come out and say, we want to take you down. We're going to block semiconductor sales to you. We're going to, you know, we want to take your economy down. Like, hardly a day goes by without somebody senior in the US saying it, from, Commerce Secretary Gina Raimondo to Mike Pence to, I mean, they're all saying it all day long.
okay.
So he gets that message, and then he knows that when the US means business, when the US does want to take you down, they prevent you from having access to the US dollar. They did that to Venezuela, they did that to Sudan, they did that to Iran, they did that to Russia. And so if you're China, you're probably thinking, you know what? Remaining dependent on the US dollar inherently means remaining dependent on the US. And if you have aspirations of independence, then aspirations of being your own superpower, that is unacceptable. So you have no choice but to de-dollarize your economy. Now, you cannot de-dollarize if your economy is weak, if your currency is weak, and you cannot de-dollarize if your bond market is weak. If you want to go to South Korea, to Thailand, and say, hey, let's trade in renminbi, keep some of your reserves in renminbi, keep some of your working capital in renminbi, the renminbi needs to be strong, and the bond market needs to be strong. And this is why, I've argued for the past 10 years, the best bond market to own is the Chinese government bond market. Now, this brings you to today's challenge. That was easy to do when Chinese bond yields were 5 and US bond yields were 2. It was easy for Chinese bonds to outperform. Now that US government bonds are, let's say, 3.84, and Chinese bonds are around 2, now you need the renminbi to rise if RMB bonds are going to keep outperforming. You can't just outperform through the difference in interest rate or through the compression in rates. You've cashed that in. Now you're in a situation where, if nothing moves, if you keep the renminbi where it is, and renminbi bond yields are 2 and US bond yields are 4, you're going to be underperforming for the next, by 2% a year. I mean, mathematically. So you have no choice now. If you want to remain credible vis-a-vis the Bank of Korea, the Bank of Indonesia, the South Africa Central Bank, this whole BRICS block that you've built bit by bit, that you've built, expanded a lot of credibility on and a lot of political capital on, for that to continue now, you have no choice but to drive the US dollar higher. Now, as it turns out, you're getting lucky. You're getting lucky because now the Fed is saying, I'm going to be cutting. Because now the Fed is saying, you know what? I used to manage for 2% average inflation, but now really 2% is the floor. And, if it's 2.3, 2.4, that's good enough, close enough. Because now you have, US political candidates that go around actually basically openly saying that they want a weaker dollar. So
which is shocking.
I know. So against all this, you now have an environment where the renminbi is going to be a strong currency. Like politically, everything is aligning for the renminbi to be a strong currency. Now I'll come back to your point on Russell Napier. So Chinese policymakers, yes, bonds were the first priority. Currency was the first priority, bonds second, equity third. While in the US, it was equity first, bond second, and currency we don't even care about. Dollar settles where it settles. We don't care. So you had very different priorities. Now, does this mean that equities are a zero? No. Just means that they're variable of adjustment, which is probably how it should be. Equities should be the variable of adjustment. Equities are there. They should be the last guys to get served at the dinner table. It's like, if there's lots left, they get everything left.
Right.
And if there's nothing left, tough shit. That's why you're the equity holder. And And in China, they have had the order right. First currency, then bonds, last equities. And yes, for the past 5, 6 years, we've had a hell of a balance sheet recession, which meant that by the time the equity guys showed up at the dinner table, there's not a whole lot left. But
Right.
meanwhile, what's happened in the past 5 years, and what I think most people are missing again, is in the past 5 years, you've had tremendous productivity gains. Corporate earnings actually rose in 2023 from 2022 on the back of these productivity gains, even as growth continued to decelerate. Corporate earnings reaccelerated. Um, and what you are now seeing, I think, in China is these productivity gains are being reflected through these enormous and gargantuan current account surpluses and trade surpluses. Now, for now, as we discussed, these trade surpluses are staying outside China. The bull market story for Chinese equities is not that all of a sudden foreigners like you and I decide, you know what, let's have a punt on Chinese equities. The bull story is that the guys who are earning 100 billion a month start to say, you know what, my currency is going up, their currency is going down. Maybe I should put my assets at home. And if
Wow.
at the same time you get some kind of improvement in the foreign policy relations between China and the US, then that could go very, very quickly. And here, I think there's a clear choice between Trump and Harris, where Harris, in their convention speech, basically took the Biden line of foreign policies of good democracies versus bad non-democracies, united Western world against everybody, following the Biden line. While Trump, and I think that's one of the more interesting statements he's made this campaign, has said a number of times, I'd be very happy for BYD to set up factories in Ohio, for Exxon to set up factories in Michigan, for Enio to set up factories in Tennessee. If they want to sell here and then they can produce here and we're all happy. So it shows that for Trump, China is an economic rival, but it's not an enemy.
Okay.
And and that Trump takes an approach to China, which is likely to be far more transactional. Now, if Trump is elected, I, I think we get a much weaker dollar because that's what he wants. He's been
Yep.
very vocal about it. I think we get a much more transactional relationship with China. And all of a sudden, the idea that China is uninvestable goes out the window and the stock market triples.
Oh, okay.
But from
Yeah.
current
Yeah.
conditions,
Okay.
look,
I can hear it.
stocks like JD.com, Baba, Tencent, they're all trading at like between 50 and 100% of the cash they have on the books.
Oh, they're that cheap.
Oh yeah.
Oh, I didn't realize that they'd gone that cheap.
I'm exaggerating a little bit. JD has got like 80% of its cash on its books,
Yeah.
of its market, 80% of its market cap in cash. If you look at Tencent, it's about 20%, but they're all within that range.
Yeah.
And
They're cheap.
these stocks can double and triple in a heartbeat.
Oh, for sure. One of the things that kind of shocks me about the recent American attitude towards China is that they're so intertwined. Like I don't get why they somehow think that they can be so adversarial. Because, like, let's face it, like, what's you mentioned Nvidia, but like, what's Apple gonna do? What's Tesla gonna do? Like, there like these economies, like America needs China almost as much as China needs America, or probably more so.
I think you're seeing an example of this right now, actually. There's been a bit of a tiff between Tencent and so Tencent runs the WeChat app,
Right.
which is, you can't really be in China without WeChat at this point.
Okay.
To order like anything I mean, it's basically to order a taxi, you need WeChat. I mean, it's a payments app. It's like WhatsApp payments. I mean, it does everything for you.
Right.
Now, Apple told Tencent, we need to take 30% of everything that's booked through WeChat because that's the Apple business model, right? It's that the 30% toll you pay at the gate. And WeChat said, yeah, no, we're not going to pay that.
How'd that go?
It's not going to work. Um, and And Apple told WeChat essentially, well, if you don't do that, we're not going to do any upgrades to the WeChat app. And then WeChat said, well, if you do that, nobody's going to buy an iPhone. Uh, so what's it going to be? And this is where we stand.
Right.
So yes, at some point, you become embedded. And for Apple, iPhones in China are like 25% of their sales. So you
But
can't.
even more scary than that is the fact that 100% of iPhones are, or not 100%, but I'm pretty sure
Yeah, they're all made there.
they're all made there. So like, you sit there, you get belligerent with China, and China goes, well, guess what? You know what? We're going to close you. We're not making your phones anymore.
Yeah.
And it kind of actually shocks me that we're so adversarial and kind of a another entity that's so crucial and tied to our economy in such a big way.
Well, and to be honest, I think that's been the big wake up call and the realization of the past 2 years. Um, I think Trump did start, in 2018 to bash China and put in the semiconductor blockade, and then Biden amplified that. But at the back end, I think you have a lot of U.S. corporates that are lobbying aggressively to be like, tone it down, tone it
Right.
down,
Like
tone it down.
Apple's
And
talking to him about fixing that. Like,
yeah, I think at the back end there's a lot of this. But to your point on the interconnectedness of the world that we live in, and how basically a new Cold War really isn't possible, because when we had the Cold War with the Soviet Union, we basically traded nothing with the Soviet Union.
right.
There
We
was
didn't
very
need anything from them.
well, we needed some commodities, but we bought
Did
that
we really though? Like
a little bit. But you're right. I
but
mean,
other people could buy it from them, and like commodities, like you could figure it out. But like Apple's not gonna like buy their phones like through India.
no, they're trying, but it's extremely hard. The reality, what we're finding out, same story with all the reindustrialization plans in the U.S., etc., is that you know building an industry, a sort of industrial network, takes 30 or 40 years. You need the 40-year-old workers to train the 20-year-old workers, and once you lost it, like the U.S. has lost it, um, then you can't get it back. And I think we've just had a huge wake up call on this with the Russia Ukraine war. When Russia invaded Ukraine, we, the Western world, told Ukraine, look, stand up to the bullies. We'll back you. Russia is a gas station masquerading as a country. We're going to turn the ruble into rubble, and we're going to just like give you so many weapons that Russia's we're not going to be able to compete. And 2 years later, we find out that Russia fires more 155 millimeter artillery shells in a given month than we can produce, than we, the entire Western world, can produce in a whole year.
Right.
And so what we found out is actually, if we want to claim to still be the military dominant powers in the world, then you can't do that without industry. If you're the US, you can't have 2% of the global steel production and be the world's military hegemon. That just doesn't add up.
Yeah.
Well, not it's fine. It's fine if you're like, I'm going to buy my steel from China and I'm going to invade Iraq. Then that's fine. That's cool. But the premise of I'm going to buy my steel from China
And then threaten them.
and then threaten them and potentially invade them, that part doesn't work.
Right. I get it. All right. Wow, Louis, I could talk to you all day. Like, what do you think? Like, I'm going to turn it over to you. What do you think the big opportunities are out there right now?
Damn it! I was about to ask you the same thing. This is no. Honestly, this is a huge challenge, right? Today, if I asked you, give me something that you'll bet your left hand that you're convinced will be a three-bagger over the next 5 years or something.
Yeah.
It's really challenging today.
Yeah, no, it's gotten tough. No doubt about it. A lot of things seem fully priced. Although, having said that, you could make a good case for Chinese equities. Those are
like, if you tell me, look, what could be a three-bagger, and if it's not, you'll lose your left hand. I would pick some Chinese equities because they are cheap. They're beaten up, but we do live in a world where, look, let's take the U.S. as an example. You take the US equity market as a percentage of GDP, it's never been higher. You take US debt, government debt as a percentage of GDP, and it's never been higher. You take US corporate debt as a percentage of GDP, it's been higher in the past, but it's still pretty darn high.
Right.
And you take US private assets, private equity, venture cap, all that jazz, as a percentage of GDP. And here we've gone from 5% of GDP to 50% of GDP in the past couple of decades. So all I'm saying is, that poor GDP is like the proverbial camel on which you keep loading more and more stuff on his back.
Right.
He's got to work harder and harder to service all these different assets that are all expecting returns. You've got the equities. Oh, I'm expecting 11% a year for the next decade. And private equity, I'm expecting 15. And bonds, oh, well, first you pay me my 4%. And corporate bonds, well, you got to pay me my 6. And that GDP, and by the way, that it's the private sector GDP that has to pay for all these things.
Right.
Because GDP is a funky measure where you add, government and private sector. Now government keeps getting bigger and bigger within GDP. Private sector keeps getting smaller and smaller and has all this stuff loaded on its back. And you look at it and you're like, damn, like that private sector GDP better have a strong back and some strong legs, because he's having to carry a lot.
What do you say though? Looking at it, the developed world is probably the most overpriced, like versus emerging markets. Like if you were to say like you have to put on something, you have to hold it for the next decade, wouldn't you kind of make the case that maybe emerging markets are what you should own, and it's really kind of the fact that the S&P trades at 21 times this elevated earnings with 30% in 5 stocks that are based upon this AI. Like those are the assets that seem to me that, and not only that, in a currency that's way more expensive than everything else. Like those are the things that look to me like they could be a disaster.
Okay, so let me start off with just something very plain obvious. The US today is more than 2/3 of the global equity market cap.
Yep.
It's 2% of global GDP, and it's 4% of the world population. Now, if it's 2/3 of the global market cap, then you're assuming that US companies are going to be generating 2/3 of the corporate profits for the next decade, and then some.
Right.
Because otherwise, what's the point? Like,
Yep.
when you buy an equity, you buy a stream of future earnings. So do you think that it's mathematically possible for 4% of the world population and 20% of global GDP to account for 2/3 of the world's profits? I don't think it's mathematically possible.
Right.
I just don't. So that's part of your answer for your question. Then I'm going to put it also, I'm going to give you another simple example. Right now, the Fed has telegraphed that they were going to cut. Brazil is telegraphing that they're going to raise. And there's a bit of a fight between Lula and the central bank right now. We'll see how much the Brazilian central bank is. So right now, you can go out and buy, 10-year US Treasuries. What's the yield today? 3.8, something like that. Let's say that if you assume that inflation is going to be 2.3, so you're getting 1.5% real,
Okay.
give or take. So you're getting 1.5% real on your 10-year US Treasury. You've got this option. I can go out and buy Brazilian tips, yielding me 5.5, with a central bank that's actually fighting in my corner, that's going to be raising interest rates, and that's going to be making sure that inflation doesn't come back. While the Fed is like, inflation 2.3, that's close enough to 2, party on. Let's print a bunch of money. Like, who in their right mind buys the 10-year US Treasury instead of a Brazilian tips? Again, I think nobody in their right mind would do this, except you do it because it's your job. You don't do it because you think, I'm going to make more money here than there. You do it because if I take the Brazilian tips and it doesn't work out, I lose my job. If I buy your US Treasury and it doesn't work out, it's like, it was a 10-year, we live in a business where if you want to fail, you want to fail very unspectacularly. You want to fail along with everybody else.
Right.
And then you're fine. This is the rules of our business. But today, you would be mad to buy any government bonds, I would say, outside of Latin America, outside of emerging markets, but really Latin America. You've got real yields on offer in Latin America that you just don't find anywhere else. Um, so yeah, and by
So
the way, one of the reason I particularly like Brazilian bonds today
yeah,
is I think we've just had a trial by fire. Coming into the summer, one of my big fears was the yen is stupidly undervalued. At some point, it's going to rally. And when it rallies, all these carry trades like Mexican peso,
yep,
Brazilian reais, like historically, each time the yen
right,
rallies, these things get crushed. And
yeah,
Mexico did get crushed, but Brazil did not.
right.
Brazil
One of
did not. So that's a nice trial by fire right there, where we've just gone through. When you look at the difference in the behavior of the Mexican bond market and the Brazilian bond market over the past couple of months, you're like, okay, Brazilian bond market, that's not owned by a bunch of weak hands who or a bunch of overlevered players who get squeezed at the first sign of trouble. So I feel pretty comfortable there.
I have a buddy that one of his pet peeves in finance is the fact that nobody talks real, or very few people talk real. And I was struck when you were sitting here giving me these kind of different ideas out there. You were doing nothing but talking real. So, do you agree with my buddy that not enough people focus on real returns? And do you think
Absolutely.
that's changing?
I think it is changing because inflation is now here. Now, for most of, you and I are roughly the same ages. For
Yep.
most of our careers, we lived in a broadly deflationary world. Um, and so we didn't have to worry too much about inflation. And this is now, we've just had a hell of a wake up call. Now you could say, well, this was just a one off, etc. I happen to be a structural inflationista for a number of reasons, but the number one reasons is for me, the incapacity that Western welfare states will have in controlling their budget deficits. Uh, and I think we've tipped over now where demographically, for a number of reasons, uh, you know, the the revenue will never catch up with the expenses, however hard we may try. Um, and so, you know, de facto, that brings you to inflation. My favorite definition of inflation was Jacques Rueff's, who said, "Inflation is subsidizing expenditures that give no return with money that does not exist." Uh, what what bigger expenditure that gives no return is there than pension payments? Um,
That's funny.
pension payment is the very definition of an expenditure that gives no returns.
Right.
You're spending money, and yet you look at Western country after Western country. What are they doing? They're slashing education budgets so that it can buy the votes of the boomers. Uh,
Oh, yeah,
and,
that's a great way of putting it. You're absolutely right.
and and if that's not inflationary, then I don't know what is. So anyway,
Yeah.
all this to say that in an inflationary world, I think the reason I don't know where your buddy's from. I'm going to bet he's
He's
from
from Toronto,
emerging
actually.
markets.
No, he's
Yeah.
a Torontonian.
Oh, so he is emerging market.
That's a great line.
No. The, so okay, no, jokes aside, I think if you like lived most of your life in emerging markets, and I have,
Yep.
you think in real terms because that's the world you live in. You've lived in a world where you've always dealt with inflation. And I
Yeah.
think if you live, so your buddy is actually quite original in that if you've lived in Toronto and London and New York, you didn't have to think about inflation, but now you do.
Yeah. I did see that. I thought it was kind of amusing. There was a bunch of buy side clients and consultants that got together and did an open letter to the hedge fund industry saying you should have hurdles back in your performance fees, because I guess for a while there was no hurdle rate because inflation was so low and interest rates were so low. They
Yeah,
would pay the 20% of everything above zero. Now all of a sudden, guys can sit there and just be long and, cash earn 5% and then have to pay 20% on that.
yeah, absolutely. But
All right. Louis, it's been a real pleasure having you on. But before you go, we're going to talk a little bit about something fun. One of the things that you are passionate about is rugby. And I was looking this up. I had no idea. I was like, what is this Frenchman doing? Like, he's passionate about rugby. I had no idea, first of all, that it was introduced to France in 1872. So you
that's right.
have a long history of actually being rugby fans. I see that you actually hosted it the other day in 2023. You hosted it.
Yeah, we
Did
listened
you
to the World
go?
Cup. I did, and it was.
And so you had a heartbreaker. Like, were you at that game?
I wasn't
Okay.
very, very, very cockily. I booked myself in for the semifinals and final.
Oh,
Uh, but my two teenage
you
sons.
Gucci'd it.
Yeah, I go to it exactly. My two teen. I went to the opening game.
Okay.
So what I went to the opening game against. We were playing the All Blacks, and
Right.
which is like the royalty of rugby. They're the best there is, and we crushed them. And I thought, all right, here we go. We're owning this. So I just said I'll do the semifinals and final. And I had tickets for the quarters, the French quarter,
Yep.
and I give my tickets to my 2 teenage son and my dad
Okay.
uh,
Oh,
to
that's nice. So somebody
go to
from
the
your
game.
family went, and they
Well,
lost by
I
one.
blame them because we lost by 1 point, so obviously they didn't cheer enough.
It's all
If
their
I'd
fault.
been there, it would have been completely different.
Now, how popular is rugby in France? Like, am I just not aware of it? Like, or are you unusual in how much you
No,
love?
it's actually a regional sport. So France. If you think of France, we have 4 big rivers in France.
Okay.
One of them cuts France from east to west, called La Loire,
Okay.
sort of in the middle, and the other cuts France. From north to south in
Yep.
the middle, the La Loire, and east to west, the Rhône.
Okay.
So typically, if you're from France, or if you're traveling through France, if you ever rent a car and drive through, you'll find that anything south of the Loire and west of the Rhône,
Yeah.
you go through a town, it will be a rugby pitch.
Really?
And if you're north or east, then it'll be a soccer pitch. Um,
Oh,
so I'm from the southwest of France, where rugby is really a religion. Like nobody plays soccer. Everybody just plays rugby. Uh,
really? I
yeah.
had no idea.
So
What do
it's a
you?
very regional.
It just kind of like it stuck, and everyone decided that soccer is
Yeah,
not
it's
as much fun as
so
swimming.
well. It depends. It's actually it carves out that other part of France is the industrial part of France,
Yeah.
and that part of France is the agricultural part of France. And rugby is fundamentally a farmer sport. It used to be a farmer sport, so it was introduced in France by the Brits. But before that, we had another game called La Soule, where one village would play another village, and it would be a free for all and just a big fight. So it sort of had and the point of La Soule was you had to bring the ball into the church of the other guy.
Come
Um,
on.
yeah,
Honest
yeah.
to goodness.
So it was village against village, and you brought the ball into the church of the other guy, and pretty much it was like, you weren't allowed to bring weapons, but it was a free for all apart from that. And so
I
from
think we
there,
should bring that back. That sounds like a lot of fun.
yeah, I don't think we have enough trouble getting moms to sign up their kids for rugby. But I think it'll be tough to get moms to sign up there. This was back in the days when you had 8 boys, so if you lost one at the school game, it
That's
didn't
right.
really
Who
matter all
cares?
too much.
All right. One last thing before we let you go. I have my thing I call the triple B's. You got to tell us one new thing that you've come across, which is either a book, a band, or a broadcast, which I'll define as a TV show, podcast, anything of that nature that you've just recently stumbled upon that you love.
Uh, can I do coloring books?
You can do whatever you like. If you're busy coloring, you
No,
tell us about the coloring books you're doing.
no, I'm kidding. Look, I've just finished a terrific book, but before I go into the terrific book I finished,
Yeah.
I want to talk about, perhaps if I can, the book that's shaped my career the most.
Sure. We'd love to
Uh,
hear about that.
and so it was written in the 60s. There's actually 2 books, and I give them to everybody to read in my firm. It was written by a guy called Cecil Northcote Parkinson. He was an Oxford historian, and he wrote 2 books. The first, the one he's very famous for, is called Parkinson's Law, and it's like
Okay.
60 pages. You can download it for free on the internet. Um, Parkinson's Law basically explains to you how organizations grow. How people recruit other people, how bureaucracies come about, and in 60 pages, you learn everything you need to learn about how an organization functions.
Okay.
And it's one of the most valuable things I've ever read. And once you've read it, you see examples of Parkinson's law everywhere around you in your life. So I highly recommend your readers to read that. And on the back of that, that was a huge success in Britain. He wrote another book called East West, which frankly has shaped my thinking about the world. And, there's many theories of history, like Marx's class warfare, et cetera, et cetera. You can have many, many different theories. His theory of history is that it's basically a swing between Asia and Europe, and within Europe, he includes the United States, and he goes through it, where basically you have a power void in Asia, and that allows Europe to get strong. And then you have a power void in Europe, and that allows Asia to get strong. And it goes like this. And he goes through the examples, and it's fascinating. And the power swings from one to the next are usually quite painful. And perhaps that's what we're going through today, which is why I mentioned it. Which
That's
brings me,
great.
which brings me to my third book, the new
Okay.
book. You wanted a new book.
I
Uh,
wanted one new one.
I just finished a book by called Money Machine.
Okay.
And it came out late last year. It's written by a gentleman called Wei-Jian Shan. And Wei-Jian Shan runs one of the biggest private equity firms in Hong Kong called PAG. And the Money Machine goes back to a time where he Wei Jianshan basically did the first major private equity deal in China, takeover of a Chinese bank. It was for TPG. He took over Shenzhen Development Bank. Now, what's amazing about the story is that it was just 20 years ago. And you
Okay.
read it today and you're like, oh my God, like China has evolved so much in 20 years. You read it today and it feels like it's such a vignette. It might as well be 100 years ago.
Right.
It is, as you read this today, it allows you to really crystallize the progress that has been done. Because the deal was done, the Shenzhen Development Bank deal was done in 2004. So literally, I think, 2003 or 2004.
Right.
It allows you to crystallize, again, China's progress in such a small period of time.
That's
So it's
great.
called Money Machine by Wei Jianshan.
That is awesome. Louis, I've had so much fun. Why don't you tell people, first of all, if people want to get you, you're actually now on X, right? Every
I
now
am.
and then.
I am
see
every now
you
and then.
getting into trouble there. This guy's willing to go for stuff that scares some of our mutual friends. And so if you want fun Twitter or X, whatever it is, go check it out. First of all, tell people where your X is.
So it's at Gav Vincent. Vincent's my middle name.
Okay.
Yeah.
So go check him out. And then for institutional clients that are interested in learning about Gavekal, how should they reach out to you?
Yeah, the easiest is, to be honest, so first you can always reach out on my email. It's Louis, spelled like the French kings with an S at the end. I say that because a lot of Americans spell it with an E at the end.
Oh, really?
At gavekal.com. So Gavekal.com. And then our website is gavekal.com. You can find like all the stuff we do there.
That's
But if
true.
you want to reach out to me, easiest is shoot me an email or ping me through X. Yeah, that's also
Ping
easy.
them through X. There you go. You had given it up, and now you're back.
I gave it up for a while, and
You
to
couldn't
be honest,
resist.
well, it's a fun way to filter through information quickly.
Well, that's true. There's a lot of benefit in terms of you do get lots of information very quickly, like in terms of like a fire hose and stuff like that.
Yeah.
So there's no doubt about it. Listen, Louis, it's been great having you on. I really appreciate you spending some time with us on this Friday. I'm looking forward to you and I going and hitting the ski hill, right?
Dude, make it happen. You name the day.
I got to go. We got to come. We got to go out and do some cat skiing, or maybe even pony up and do something
Yeah,
with the little
absolutely.
fancier and stuff like that. Although I'm kind of scared of you because you live on that hill almost, and you
Yeah, I
have
know.
young kids. Not young, but you have young enough kids that you're skiing with.
Of
Do you
course, I
ski
have
every
teenagers.
weekend? You ski every weekend?
Not every weekend. I wish I did. And to be honest, this past season I busted my leg, so skiing. So I
Oh,
barely
what
skied
happened?
any.
Oh, you did
Nothing too bad, but I tore. I
Okay,
tore
and
my
I
knee.
blame that completely on the Whistler wet cement snow that you guys have, right?
There's that, and I blame it on me trying to keep up with my two teenage sons.
I know.
Uh,
Listen, I gave
it's mostly
myself
that.
I
It's
gave
mostly
myself
that.
a concussion chasing my son down a hill in Golden on a mountain bike. So I completely understand that. All right. Thanks again, Louis. Great having you
Great
on,
to
buddy.
see you. Thank
Thanks.
you very
Bye-bye.
much.
Patrick, it's time for talking charts. Been quite a couple of weeks. What do you got for us?
What a whipsaw! But let's quickly go through what we were watching 2 weeks ago. So one, we were looking for the OPEX volatility going into the option expiration. We were looking at the inflation numbers and asking if the bull market was over. And well,
Oh,
what
that
a
number one
rebound!
was definitely going to be up for grabs. There's a lot of signs that the bull market is not over, and in fact, we got the S&P equal weight breaking out to new highs. all of a sudden you have a bid in the small caps and the value. Like a lot of things are the rotation into other stocks is actually causing the market to look a lot stronger than it has in a while.
Yeah, I mean, this was a reflexive buy on dip, and the pain trade has been the market going higher. The thing is, when this market is advancing, well, we'll put up a chart in a moment, but when the market is advancing this way, it was very unlikely that it was going to be the Mag 7s that were going to lead the way they did in the past. And so, in order for the market to make it to the levels where it was, it had to be a broader rally. Like it was either going to not happen or it had to be a broader rally, and that's the way manifested. But let's talk a
So
little bit
wait,
more.
actually, before you kind of go on to that, if you go back and kind of go back a month ago, a lot of people were saying this couldn't happen. You couldn't get a rally in the broader market with the Mag 7 going down, and this wouldn't occur. And yet here we are.
I
We
want to
are
talk about
seeing.
it. I want to talk
Okay.
about this. Let's get the charts up in a moment.
Okay.
Let's go through the top three, and then we'll put up all of these different metrics. Okay, so the let's talk about the top three things we're watching for the upcoming 2 weeks. And we have the core PCE number coming out, and this is going to be one of the interesting things to watch, simply because obviously now it's pretty much a certainty the Fed is going to act and we're going to get a cut. Then the big story now is it going to be one or two rate cuts, and the inflation numbers and the jobs numbers, which is number two, are probably the two inputs coming up in the next 2 weeks that will be a very large influence as to whether there is one or two. Do you agree with this?
Yeah, you've nailed it. And I think the jobs numbers especially will dictate that. And having said that, I'm in the camp that he's not going to go 50. There's very little chance of that occurring. The market
Well,
is
the
overly
market's still
excited.
pricing one third.
No,
It's a
I
one
listen,
third,
I'm
two
not
thirds.
disagreeing with you. I'm just saying that I think that it's very unlikely unless we get a jobs number that really surprises with a lot of jobs losses. I'd be shocked. You'd
What
have to have
what's your take on the massive revision?
uh well, my
It was
take is
expected. We knew that was some point it was going
well,
to happen, because it was typical that initial that it's always revisions backwards, and that you
but they're
can't really.
never usually this high. And to be
Yes,
fair, yes, there was some whispers in the week before, but up until that point, nobody had really been talking about it. And it was very unusual to see the market so focused on that. That ended up being the actual important number of the week.
yeah,
Everyone was sitting around and watching that. Yes, of course, the Jackson Hole speech was more important, but in terms of economic releases, this actual revision
yeah,
number ended up being something the market was focused on. My take about that is it just goes to show you how much the market grabs hold of these um, month to month numbers and interprets so many different things into it, and yet here we are and they're actually revising it by what, 60,000 every month,
yeah,
like lower. So all those numbers that we got all bent out of shape on, they were 60,000 overstated, like in terms of jobs growth.
yeah,
So, you'd think that after seeing that, the market might go, hey, wait, these numbers, when we're sitting around getting all excited about, the month to month change, maybe we shouldn't assign that much, like accuracy in terms of those numbers, and yet that's not what's happening. And to me, it's just a sign that the economy is not quite as strong as everyone expected, and that this has been really, if you think about it, Patrick, one of the reasons that the Fed has kept rates for so high for so long has been that you know, let's face it, the unemployment number has been better than everyone expected, but in hindsight, it hasn't been.
yeah. It's interesting. Nomura came out, and they've been in that camp all along that that soft landing is a pipe dream. But ultimately, they weren't bearish in the sense of saying that there was going to be a huge recession, but simply that a soft landing was not likely. And now the idea that a recession is coming. I mean, some of these different analysts out there have as much as like a 40% chance at this point. They play this numbers game,
Yeah. Well,
in
I think
terms.
Daryl Perkins has this great rule about 40%. You can the strategist should always say 40% because when it doesn't happen, it's higher than 10 or
Yeah,
20, but yet it's still less than half. So when it doesn't happen, You can be
Yeah.
like, well, you know what? I actually predicted it was not going to happen. And yet you can go, he's got a great, Dario's like just hilarious
But
to me.
that's the game. That's the game all
Yeah,
analysts play, right? Like
no, for
it's
sure.
the way they keep their jobs.
Yeah.
It's they're gaming the prediction. Okay. Anyway, number one, let's talk about this, and then I want to talk about the breadth of the market and things like this. But number one, Nvidia earnings, and it is the thing to watch, right? Because there isn't much lined up this summer until the jobs number. And so if there was something that was going to move it, like let's be realistic, Jackson Hole, it's going to be very hard to get something out of Powell that is out of line with what's been already well advertised and anticipated. And so the idea that this was going to be a big market mover has a diminishing. You wrote a piece on it, which I didn't read, by the way. What was your comments?
I like the honesty. Well, actually, I came out and threw cold water on the idea that Powell's going to say anything that was,
Okay.
new. And I would say now, after like we're recording this at lunch, and a lot of people seem to be very excited about what he's saying, And to me, the only real thing that was new in terms of his comments was the acknowledgement that the unemployment or the labor market was softening. And then the real kind of, to me, the real kind of different thing that he put out there was he said, further labor weakness is not welcome, nor will it be tolerated. And that to me had a little bit more of a bite to it. It felt like, oh, he's really putting down his foot and he's saying, nope, we don't want any more labor softness. But if you stop and
Yeah.
think about it, he's got to acknowledge that the labor market is softening, Patrick. Like, we had the SOM rule. Now we can debate whether it actually should be used the same way because of the differences in the labor market. But the reality is that the unemployment was 3.5. It's now 4.3. SOM rule kicked in. A Federal Reserve that doesn't acknowledge this and doesn't kind of push switch us from a neutral to an easing bias is not doing their job. They have a
Yeah.
dual mandate, and the growth side of the equation is now up for grabs, and he is forced to do that. The real question is, and you addressed this earlier, you said the market still has a 1/3 chance of a 50. How fast does he go? What is the
Mhm.
pace of it, and where does he eventually end up? I happen to think that he's going to go way slower than anyone expects,
Yep.
and then he's going to go 25, and he's going to wait another meeting, and then he's might go another 25, and he's going to wait another meeting. There's no emergency. There's no actual need for him to panic and go fast.
And this is why often it ultimately leads to some sort of economic catalyst that forces them to be even that much more aggressive. Like just
Right.
because they're not acting fast enough, they're behind
Yeah.
the ball in terms of that, and that usually is the way it plays out. Okay, let's put up that chart though of Nvidia,
Okay.
and we basically had an extraordinary pain trade rally. A lot of people were already abandoning the trade. Nvidia, what from its peak to trough, had a correction that was in the 35%, 1/3 of its value. That was in itself, it just shows the volatility of of the name. But the point here is that we already had a correction, and the pain trade was the snapback rally, and now it's screaming higher. But it's going to really be the earnings that is going to decide this, and it's actually, I think, incredibly important because even the breadth that you keep talking about being that so impressive, if there's any indication that the AI capex spending cycle has run its course and the guidance. First of all, I think Nvidia comes in line with the earnings expectation. I don't think there's any surprise on the numbers themselves. It's all to me about their guidance. It's about
Okay.
whether or not they're anticipating and whether the analysts are getting or sniffing out from their language that the capex cycle is mature, and
Right.
it's turning. And if that
It doesn't even need
happens,
to be turning. It just needs to be slowing.
slowing, turning, whatever, like point is or sales revisions or
Yeah.
anything like this, that if anything like that creeps in,
Yeah.
um, Nvidia is
Well,
going to get hammered.
right.
And
Because let's face it, Patrick, it's trading 35 times sales
yeah,
or something like that. When you have
mhm,
a stock that's priced for that sort of perfection, you need to keep growing. And at the moment that the market smells that that growth is slowing, they're
yeah.
going to punish it. And it is an expensive stock.
It's the question is, does it happen this quarter? This is why it's the number one thing
Yeah.
to watch, because we're talking like it's a given. It's not a given. The whole
Well,
thing could be
it's
pushed out.
eventually going to have to be a given, Patrick, because
Uh,
of the
but is it
market.
this quarter? Is it this
No, I know,
quarter?
but the market has priced in so much growth that it'll eventually surpass. They'll need another. They'll have to go outside the world and be selling to Mars to
Yeah.
actually justify this sort of growth.
The part that is the observation I would make. So let's just be agnostic to say that's a 50-50 chance that this is the quarter that it ends, and 50% chance it doesn't. Let's just leave it at that. That's not where our prediction lies. To me, it's about the implications, which is if Nvidia disappoints, the shockwave through the other Mag sevens is going to be there.
Right.
And the idea that the breadth of the market and the small caps and all the other sectors that have been playing are going to somehow hold the market up is nonsense. I think that the market trend will actually be dramatically influenced by what happens here to the Mag sevens.
I see.
And
I'll take the other side of that. I'll fade that.
all
I
right,
think that if I
let's
think if all of a sudden Nvidia were to just disappoint, I think that the other there would be a huge rotation, and you would see the other stuff scream. Because don't forget, the Mag 7 is so large on a market cap that you could actually, as they sell that, to go buy small caps or go buy energy or anything, they're going to move it more. So although I might agree with you that the S&P 500 might decline, the Nasdaq might decline, you could see a situation where the S&P 400 mid caps or the S&P 600 small caps or the value indexes just rip.
I
They
mean, we
just could
saw
be
we
up
saw
a
it
lot.
when the Nasdaq Russell factor, like long short combo, got hammered. There was that one
Yeah,
window where it just ripped, and you're basically saying that deja vu. You're going to see another kind of impulse of that kind of magnitude.
if
Um,
if Nvidia disappoints, yes, I do believe that that will be the case.
I'm not going to agree with you. Like, I mean, I get it. I get it because most of these money managers have mandates to stay fully invested in
Yeah,
rotation and changing their overweights or equal weights down to an underweight, and they have to sprinkle that money abroad. Is the principle that you're trying to say? And
right.
I can't say the probability of that is zero. I mean, there's a reasonable chance it can happen, but I actually. Think where you look at where we are in the market cycle, close to a Fed rate cut cycle, a tight labor market, or sorry, not a tight labor market, but a labor market that is starting to soften. All of these factors, the idea that the rest of the stock market is just going to be ripping in a seasonally poor period for the stock market where typical flows don't come in. I say that there's a lot of things that can go wrong with your little theory.
All right, so listen, I'm not going to disagree and say that this will ensure that those go up. I just think that positioning is so lopsided towards those
Yeah.
Mag 7. If you did get a rotation, you might be surprised at the strength of those different things. And Patrick, today I think is a great example. As I said, we're recording this at like noon on the actual Jackson Hole day. Powell comes out. He's interpreted as being more dovish than expected. So what happens? The market increases the chance of a soft landing. What rips? Small caps, regional banks, the IJR, the S&P 400. What's actually down from like 10 o'clock? The Mag 7. I think that you're already seeing this rotation. The market is primed for this rotation to accelerate from here.
I uh, I think that it's a very dangerous game for. Okay, I think that when you're talking about the institutional or sophisticated hedge fund manager, particularly those that specialize in long short combinations and things like this and are playing this game on a relative basis, then you are absolutely right. You're speaking to them. There's trades to be had that where the one will outperform the other, all of this. But now we also have a number of listeners that are very traditional retail. They're not pairing long short. And they're just either going to go long equity or not. They're choosing weighting in terms of whether they should be in small caps or leave it in S&P or stay in individual names like the Mag Sevens. They're making pure long stock decision making. And I think that here, even if there's a little bit of love coming to some of these other sectors, I think generally this is not an investable thing unless you're doing a sophisticated pairing of the trades. I think this is a far more of a hedge fund trade that you're talking about, and I would be far less interested in referring, like, kind of recommending that trade to some
Yeah, well, we
retail
don't
investor.
recommend any trades, but the reality is, I think it's going to come down to your timing.
Yeah.
And I think what you're arguing is that if Nvidia shits the bed, it's going to drag everything else down. And I'm saying if Nvidia shits the bed and it ends up being a pure, like it ends up being a popping of the AI bubble, as opposed to weakness in the overall economy, I think you might be surprised at the bid that's is in the other market. Anyways, that's what makes a
Yeah,
market.
that's what makes a market. I think that it's far greater chance that it plays out like 2000 to 2003 than than you're where basically, my view is that while the Nasdaq will massively underperform and be the worst performer by far and have the greatest percentage move down, the other markets didn't rally during that period, and it's you were better off being in the S&P and the Russell during 2000 to 2003, but doesn't mean you made money.
Right. And
And I
Patrick,
think that
oh,
that's
sorry.
my view.
Okay. Well, I'll tell you one last thing. The fact that we're both talking this way and arguing about this
It's
means
only going to go higher.
Nvidia is going
It's
to
going to
surprise to the upside. Mag 7 is going to go bid, and all the other ones are going to go offered. That's what's going to happen.
there's there is a chance Nvidia beats it pushes out a quarter. It's possible. We're just talking about the risks. All right, so let's get to the chart here. The S&P 500. We can observe that the pain trade was clearly it ripping all the way back to its highs, and we are just a stone throw away from its previous highs. But for all of the relative strength today of the Russell up 3% that you're referencing, which was definitely a 1 day update that's pretty significant, we're still not back to the previous high. No different than the S&P. It is certainly been a nice update, but this is not exactly a chart that is like running away.
Can you
Uh,
pull up the S&P 400 though? The mid caps.
uh,
IJR is the
n- no,
IJR.
no, it's not it.
Is it not? Am I wrong?
No, it's not on TradingView that way.
Oh,
Anyway,
okay.
uh,
And I think that if you look at these, Patrick, that you have a situation where those are actually much closer to the highs.
yes, but what I want to observe is the breadth of the market.
Okay.
And so here, let's just start off by looking at the S&P 500 breadth. And we were basically near 75, 80% rising in the stock market back in July when the initial peak came in. And we just returned back to that level, which is a relatively high end, but we have seen much higher bullish participation in the S&P 500 before. We have not like peaked out on some sort of very huge broadening. But even when you look at something like, for instance, the NASDAQ, right? And you can observe we're still at 53% of stocks on the NASDAQ participating on the upside, nowhere near the July highs. And the thing is, the Mag 7s don't represent the vast majority of the stocks on the NASDAQ. And the NASDAQ breadth is still quite awful. Now, is there room for these to go? Can they still strengthen? Yeah, but I'm just saying, like, yeah, you're looking at the relative performance of these indices for the very short window of time, which you're absolutely making a correct observation as to what happened here. But the bigger question is that is there money to be made in these trends persisting? And that's where I think that there's just as much risk of what happened to the Russell in August, which is that it ripped and gave it all back. I think that this is far more likely what happens in the next few months, which is the markets are just going to be taken through one monstrous meat grinder. And whether it doesn't have to be a downwards market move. I just think that it's very likely that the major market highs are going to be put in very close to where we were in July and August. And I don't think the market has that much upside from here. And the likelihood that these things fade off of these highs and just fake out investors. Like, what is the pain trade? I heard the pain trade is the upside. I agree with it. I can see why some people would say the pain trade is to the upside, but I think the bigger pain trade is the market just gets stuck in a ping pong match between support resistance and fakes investors out to the upside, fakes them to the downside, meat grind sideways, creating maximum confusion, creating a lot of emotional stress that ultimately makes everyone feel incredibly uncomfortable. I think that's the pain trade.
Well, I'm not going to disagree with you there, Patrick, but I would kind of point out that part of the reason that the Russell went offered so hard there was because they priced in a recession scare. So if you believe that the recession is coming, then you probably shouldn't be owning any stocks, because the reality is that they're all going
Well,
to go
underweight.
lower.
You don't want to say any, but like
Anyways,
you want to be conservative, cash, extra
whatever.
cash.
The
Yeah.
reality is that if you were confident, if you knew a recession was coming and that it was there, there's no sense in owning stocks. But obviously, you never know for sure that the recession is coming. So, but you should be leaning that way. So that was what I would say there. But the point
Have
is,
we had
Patrick,
jobs reversions? Yes. Have we seen slowing? Yes. Like way I look at it, I'm in the recession camp. But I don't think I'm in the Numera camp, which is basically the soft landing is a pipe dream, but it doesn't mean that the recession has to be a bad one. It could just be an
okay.
economic slowdown,
And then,
right?
Patrick, I understand your argument about not owning like small caps makes a lot more sense, because in a situation where we have a recession, then chances are they
Yeah.
all go down, because that's what's happened. We saw that they all went down. Sure, Mag 7 went down more than the small caps, but on the whole, they all went down. So I guess my argument is that the recession, if all of a sudden Nvidia has problems, it might not be signaling a recession. It might be signaling a popping of the AI bubble. And that's ultimately how I'm differentiating with you. You're assuming that the popping of the AI bubble means a recession. And I'm not. And I'm saying there's a chance that that doesn't mean a recession. It just means a popping of the AI bubble. And in that situation, you could actually see that rotation play out differently. Anyways, but I just wanted to highlight, if you're correct about a recession, they all go down.
And the one thing I think listeners should, it never plays out the same twice. But there is there's a long history of the fact that the biggest bear markets always are occurring while rate cuts are occurring. And there's far too many people that are super bullish because the rate cuts are coming. But when you look historically, the worst market conditions are when the rate cuts are actually happening, because the Fed isn't cutting fast enough. And I think that there's not enough people worried about that. Everyone seems to be looking at only the benefits of rate cuts, which is that means finally the easing is coming, and the next bull market can begin from here. I'm just not in that camp. All right, Kev, let's move on. I want to talk about gold. And The commodity markets have been a disaster. Bloodbath, blood everywhere on the streets. Like there isn't anywhere to hide other than gold. Gold is the only real commodity. I mean, yeah, okay, there are a few other commodities, but gold is the only commodity that seems to continuously have support and pressing 52-week highs in a period where everything else is being taken through some sort of a meat grinder.
Well,
And anyway, to me, this is a trend that continues to look very bullish. Even though the very short-term hourly swing trade on the upside has played itself out, there's always room here that gold can pull back to its 50-day moving average to create a buy on dip. There's all sorts of like short-term volatility, but this measured move is all the way up to 2,700, which is like the symmetrical measurement forward. And there, to me, there's no reason to abandon this with this chart looking this way. This looks like a very bullish chart, and the continuation higher. Look at the way it just got bought on dip today from yesterday. Like that's a good characteristic, which is, one down day, boom, the buyers come right back in. You want to see accumulative price action, and that continues to show here.
I guess I'd say, Patrick, you talking about gold as being the best commodity. I would argue it's not a commodity.
It's
It's in
funny.
essence, it's almost a currency.
Yeah.
And the reality is that I've been saying this for a while, and I continue to say it, that the People's Bank of China and other central banks are going to be on the bid forever. And everyone that's sitting around thinking about the US dollar or thinking about real rates and trying to trade gold have missed it. The reality is that gold is being accumulated by those countries because of
Yeah.
actions that occurred once Russia invaded Ukraine. And it's just going to be a question of um, how it plays out in the time frame. But I saw it the other day, Patrick, that China announced that they were cutting back, or they hadn't bought any gold, and everyone freaked out, and everyone's like, oh, like I
It's
gotta get
over.
it.
Yeah.
It's over and stuff like that. And I'm like, okay, why would China, who's trying to accumulate gold, tell everyone that it's buying gold? It's not going to do that. Like what? Like I find it kind of amusing, and I always say, when you see that sort of worry, you should just buy gold. Wait for the opportunities. You should be buying the dips in gold, and I don't think you need to overthink it. The real
Right.
question, though, Patrick, is when do the gold stocks go up?
Well, okay, slow down here because, okay, gold miners have been making new highs in each push. Now, what they've lacked is momentum. But the gold itself hasn't had a lot of momentum in the last couple of months. But they are at 52-week highs,
Right. And I
right?
saw your
Uh,
buddy Tavi from Crestcat. He tweeted something the other day that the gold GDXJ has outperformed Nasdaq on a year-to-date basis this year.
yeah. And the
So
point
it's
is
you're
that
you're you're correct that they're not
the
as bad as everyone makes them out to be.
I think when all of those pundits, I'm not going to bother naming names, but there was this huge fashionable thing amongst many of the podcast community that were basically talking about how could you possibly own gold miners versus gold. They've, over 20 years did absolutely nothing, and gold was up, 500+% or whatever that. There was a whole thing. Literally, the moment that they started talking that way, gold stocks have been ripping.
I
Isn't
love
it
it, Patrick.
funny?
I
Isn't it
love it.
funny? Isn't it funny how like the market timing of these guys is impeccable? Um,
100%. When something's a narrative on FinTwit and everyone's talking about it, you
Fade
got
it.
to go the other way. Like you just fade them time and time again. I was just chatting with a buddy earlier about this. Remember when Powell doesn't want to be the next Arthur Burns was like
Yeah.
just so prevalent? Oh no, he's going to take rates to the moon. Blah blah. He doesn't want to be the next Arthur Burns. What happened to that? Now guys are screaming for 75 basis point emergency cuts, right? And yet the same guys were telling us that, oh no, he's going to actually put the economy into a recession because he doesn't want to be the next Arthur Burns.
Yeah.
So the more certain everyone is on FinTwit, the more you should take the other
Fade.
side.
Well, you just have to be more skeptical about the call because it's reflecting consensus view, and
Yeah.
which means that it's more or less been baked into the cake, and therefore there's very little alpha in trading that theme, right? Like that's the safest way to approach it, but a lot of times there's an opportunity to fade it
Yeah.
along the way. But gold's been moving. I want to talk a little bit about oil. Oil traded all the way to the bottom of the range. I mean, it could still poke around back to 68 to $70, but this thing has just been chewed up and continues to be stuck in this awful range. The bigger question is, will these major support lines hold and establish the bigger bottom? And I'm in the camp initially that the answer is yes. I think that, but I do think it's entirely possible that it could take a month or two of bottoming formations for oil to establish its low. Like often you'll have retesting things that will start look double bottoms or inverted head and shoulders or like all sorts of different things form because it gets stuck in a trade consolidation. So I kind of am in the camp that oil is probably close to its lows, but is going to chew investors up if they're getting too early, and because there's going to be a long hold of disappointment of the thing not moving, and often when you are invested in something that's not moving, it kind of emotionally stresses you, often makes you want to abandon the trade. Bottom line is, I think it's a good price level, but you shouldn't be overly eager to be running in too quickly without knowing the trend has turned bullish again. This is where me and you have talked about that one phrase from Stanley Druckenmiller before, which is, he says he likes to go all in the second inning of the game and know the game has even started rather than trying to catch a bottom. I'm paraphrasing it, but it's almost like at this stage, do you go in here just by price level alone and then just go and accept a long holding period where you're just going to be trading sideways and or bounced around? Or do you wait for the trend to turn back up and then start adding to the trade up there? And that's kind of, to me, my initial thinking on the way approaching oil.
One of the smartest traders I know has been selling oil puts into every dip. And to me, that's the only guy that's made money in oil lately,
Yeah.
because it's gone sideways for a long time. And I think people are overreading too much into every $5 move. And the reality is it's just bouncing around.
Yeah.
So I kind of wonder why everyone's getting excited about it either way. Like, go look at a 10-year chart. It looks at the last year, almost 2 years, just felt sideways to me.
Yeah. So let's touch on uranium. There was the guidance from what is it, Kazaprom or whatever it's called.
Yeah.
I don't even know how to pronounce it properly. I'm embarrassing myself.
No, I think we got it.
But point is that almost everything uranium bounced today because of it. And what's interesting is obviously spot uranium hasn't moved, but spot physical trust, which was trading like in the teens at a discount, quickly took a pop and closed that discount a little bit today, but it's not really moving spot yet. And so this is where you don't want to trust this rally alone. And just because some buyers came in, I want to see actual spot prices of uranium start to reflect that upturn as well. But what is interesting is definitely the uranium stocks all had a big update, like the URA, which is the ETF, quickly back to $27. Cameco up a little bit to $43. So suddenly the uranium stocks are bouncing. Is it a new bull trend? What I want to see is the classic consolidation, something that proves that it's no longer being distributed during a quick profit taking. I want to see these things dip for a couple of days and the buy on dip traders quickly come back in. I want to see a cumulative price action to really confirm it. But it was an incredibly oversold market. Like Cameco wiped out $20 on the downside, 40% in a span of a month. Right. And there's a point where while there probably was a very good reason for the sell off, that's kind of a little bit too much too quickly for such a big player. What's your take on uranium here?
I got nothing. I thought that
Okay.
you got, I think that your synopsis is actually really good.
All right. Well, thank you. The
You want to learn more?
kind of a copy.
Trading.com.
Yes. But copper is bouncing. But I actually think that you have to approach copper identical to oil, the entire outlook I had, which is was an incredibly oversold bounce. It was due to react the other way because that's just what markets do when they're so oversold. But I will not be shocked if this comes back for a retest of the low and kind of bounces around this range while Dr. Copper continues to predict a recession. Right, Kevin?
Yeah. Well, Dr. Copper is a little manic because it was only 3 months ago that it thought it was the global economy was going to explode to the upside.
Only that all the EV cars needed a little bit more of it.
Yeah.
That's what it was. No, anyway, but I still think that okay, with the $5 range being the upper boundary, I'm rounding it to the closest thing, and $4 being the lower end of the boundary. I think that copper is now, again, like oil, at the bottom end of its range. I see, while maybe, copper could spend some time under $4 just because of a quick little liquidity washout. I generally think that this is a price level that is going to prove to being where the lows will come in, but we might be waiting till October and November for this thing to be breaking out. And I think that you're just going to be grinding in this. And so I think a lot of commodities actually fit that same thing. The way oil, copper, a lot of these I think are going to take a while to really establish tradable lows. I'm in the camp like Jesse. When I was interviewing Jesse Felder, he was pointing out that often commodities sell off going into recessions and then rally during them. And I never done the analysis to be able to collaborate that. I'm not sure if I've never fact checked it, but I'm taking his word for what he said. And if that was to materialize, then as we go into this whatever economic slowdown we're about to occur, maybe this is the economic weakness going into it. And once we're in the midst of some sort of economic slowdown, maybe the commodities are forward looking enough that they're going to start pricing in the other side. And that's where we could end up seeing. And maybe it's going to be a fourth quarter or first quarter of the year story when we really see a potential new bull trend to form on some of these.
What about this, Patrick? What if
Uh-oh.
he goes and he cuts rates, and all of a sudden we get like a risk on move, and everyone
It's
is,
not. Commodities are not about the U.S. economy alone.
no, I get it,
This
I
has to be a
understand, but
synchronized global event where
right,
you
but
you would need.
what about, what if that happens? What if it
I
ends up,
don't think that's enough to move the commodity markets because
yeah,
it's not at the US economy. I think you would need the entire global system, just the way the global system tightened all at once. You would need a synchronized global easing and a massive dovish global marketplace, and that would spur it to happen sooner. But I think that's still a fourth quarter story. I mean, September rate cuts coming
yeah.
in the middle of September. Like
I think if you
like
get the soft
likelihood it
landing, I
starts here
think
in
you're
August.
dismissing the chance of a soft landing. And if you
I
got a
am.
soft landing, then you could see a situation where commodities start reacting earlier because they'll go.
Earlier, the fourth quarter is in a month, dude.
No, but I like we could see a situation where all of a sudden these things go bid as they price in the
I
increased chance of a soft landing.
There's always a chance.
Yeah,
I would not. And again, if you are in that camp, you might want to sprinkle a number of commodities in there. I wouldn't be equal weight or overweight them right now. I would be right now. The predominant downtrend is dominant. You have to wait till they've finished bleeding out, and the dead carcass is lying on the ground, and you start picking up all the bargains down along the bottom end. I still think there's room in the coming months to still be bargain hunting and waiting out for a trend reversal. That I am super bullish commodities, and I think there's going to be an amazing commodity run. All we're talking about is when will the buy signal start to emerge, and I'm just not as enthusiastic that it's imminent. I think that this is something that's going to take many months to sort out, and when it does, I'm going to be very aggressively long.
okay. I think there's a chance it happens earlier than people expect.
It's good that we don't agree because
Yeah.
whenever we agree, there's always issues.
Well, we're always wrong, so at least one of us will be right.
All right, let's quickly touch on treasury bonds, your favorite asset.
Oh God.
I hate the fact that I've been so right and you've been
Oh
so
God.
wrong.
Here we go again. I've been so right. Go
And you've been
figure
so
out.
wrong.
Go figure out. We have to talk about this again. Go figure out if the twos have outperformed the
I
tens or the
I
30s.
am I'm long the twos as much as the tens, bud. Don't
Yeah.
don't give me this.
Patrick's idea of a Texas hedge. I love it. I love it. I'm long twos. I'm long tens. I'm long 30s.
Why would you do a long short pairing? Why
Yeah.
play
I just look.
the steepener when you
I,
could just be long the whole curve?
I hedged my long position with some calls. I bought some calls.
Anyway,
Ah,
so
God.
the
Okay.
point here is that I I'm sympathetic to the secular inflation story. And the fact is, I do believe secular inflation is going to be a story of the decade. And the long-term holding of bonds is going to be a bad investment. You can give me the whole rant, your big picture rant that you always give because I don't disagree with it. But for a tactical positioning in this coming for the remainder of the year, I think that the treasury bonds are a perfectly good safe haven in this window and right across the board. And at some point, you'll have to unload them. You can't buy and hold these things. Like for instance, let's take that long bond and put it on a weekly chart and just look at the last few years. Right, this is the bear market that destroyed the bond market. It's not like we're going to go back to 150, 160 on the upside of these, right? And that yields are going to collapse back to absolutely not. But can we go and see 130, 140 on the upside of these for the rest of the year going into the first quarter of next year? I think so, and that will ultimately fade back to the lows when the next bond bear happens. But I think right now, tactically, you can be diversifying your portfolio. I think this is a year that 60-40 continues to work. Like, I think bonds are on the short term in this cycle going to help reduce volatility of portfolio, act as a hedge, and I'll take that off the table for 2025. I think it's a short-term call for the rest of this year.
Okay. That's what makes my
All right.
So
Is there something you wanted, some chart we haven't touched on, or are we good?
No, I think you did a great job.
All right.
All right.
Anyway, so that's all I got here.
That's all you got. And
That's
so,
all I got.
And we have no questions. So for people that want us to answer questions,
You got to
send them
submit them.
in to Daniel,
Well, forget
right?
that. We got a live Q&A, buddy.
Oh, is that going to be before our next show? It probably will be, because you know what? We're not going to have a Labor Day show.
I'll tell you
right?
what's going to happen is Danny's going to collect a bunch of the questions people ask that we might not have time to answer. And so if people are typing in or whatever, or putting in questions during that session, we can answer them in the next episode if there are. All right, we're making shit up. We have no idea what's going to happen.
I'm so thrilled about this move to video and now live questions.
Oh, absolutely.
All right, listen, let's go to the after show. Thanks for tuning in to the Market Huddle. We appreciate you spending some time with us. Patrick, where can they find you in your wonderful insights?
At the same place as always.
Yeah, say with me. All right, around for the after show. Okay, you're going to review a beer that you've had, what, like
a million times?
8 dozens of, like maybe even more? 25
Well,
dozens?
listen. Okay, here's what I will say. Okay, like for instance, I don't like all of this kind of like being the mainstream beer and being a fan. But when I say I can have a Steam Whistle versus having a Molson Canadian or a Labatt Blue, I'll fucking take a Steam Whistle every fucking time.
Yeah.
Like you know what? Like versus what was known as Canadian beers, this wins.
Okay,
right?
so
And that's
what we got to do, though, is you got to bring a Steam Whistle with you back to Portugal.
Okay.
And give it to Daniel. Daniel needs to give us we need Daniel.
Because you've never had one before, have you, Daniel?
Exactly.
No, I haven't.
No? Okay, I will.
Have you ever
I'm already
in Canada, Daniel?
Nope.
Oh,
No.
Patrick.
I'm bringing him back.
You should.
No, in the luggage. I don't even know. I'm gonna probably.
No, you got to bring him back to Canada.
I'm gonna get nailed. I've got like 16 beers in my freaking luggage. Like I'm waiting for me to get pulled over at the
for importing beers.
Yeah, absolutely. Like, why is your luggage 50 kilos? Well, I got beer.
All beers.
That's what it's gonna be.
Okay, we got to give us a rating.
Oh, I'm just, you know what? I'm going to give it a 7.5. I'm going to take the most down the center.
Yeah.
I like it, but
it's better than that. It's better than a 7.5.
I'm giving it a 7.5. I'm giving it a 7.5. I'm standing by it. I'm not
Daniel
going
will
to
be the one that actually settles this. That's too low.
So that means that Danny is going to have to drink 2 beers next episode.
Yeah, but it's Danny. That's no problem.
Where's the issue there?
Exactly.
Well, you're going to blend the 2 in your mouth, and you're not going to know which one's
No, he's going to do it. And I can't believe he's never been to Canada. Have you ever been to North America? Have you come to the States?
I've never flown over to the other side.
Whoa. Wow. Well, maybe you shouldn't start with Canada. Maybe you should go to the States.
Yeah, but I'm more of a mountain person anyway. So
then we got to get out to Banff. If you're a mountain person, then Banff is like outstanding. Like, it's one of the most beautiful places.
You know what's hilarious, Kev?
Yeah.
Is that I had a bunch of friends and family visit me when I lived in Toronto.
Yeah.
From Europe, and they came with a list of all the things they want to do in Canada.
And they had
and then they're like Banff and go to Vancouver and do all stuff. And I'm like, have you any clue how fucking far? Vancouver is.
I want to drive across the country.
No, but like most people don't know. I don't know if I'm factually correct, but as far as I'm aware, flying from London, England to St. John's is the same distance as going to St. John's to Vancouver.
I think
Like literally,
sounds about right.
like
Yeah.
literally flying across the Atlantic to
Yeah.
Canada
Yeah.
is the same length as going across Canada.
So Daniel,
know that.
Google Lake Louise and put Lake Louise, and you can start with that. And that's what we're gonna get you with the Blue Lake. We'll get you there. We'll start you there. Then, unfortunately, one of our nicer places is a place called Jasper, and Jasper unfortunately burned down.
Oh,
There we go. So click on one of those blue lakes. That's what it looks like.
this one.
Yeah. And then you can see
Wow.
there's actually a hotel there. If you click on the hotel, it's on the lake. It's one of our oldest the oldest kind of.
Here.
And it didn't.
No,
Oh, this one here.
yeah, you can see there. Yeah, click on that one.
Okay.
There you go. You see it?
It's a
great.
Fairmont, isn't it?
Yes, it is a Fairmont. It's beautiful.
And
Like,
it didn't,
really,
it
like
didn't
the-
burn down.
No, that didn't burn down. It's nowhere near you're talking about Jasper. And I don't know. There is one in Jasper as well. There's a Fairmont there, but it's not the same sort of things. And then there's like a nice Banff is a nice old town. It's beautiful. Like it's like we're gonna get you. We got to get you out there.
Like you could literally from Europe fly to Japan, or you could fly to Vancouver. It's the same freaking distance. It's
Yeah, it's pretty far.
It's,
Yeah, but Japan's pretty cool though.
it is.
Japan is cool too, and it's a lot cheaper.
Yeah.
It used to be until the yen
Well, it's
carry
still,
trade.
even the yen here is still super cheap. It's so cheap. My daughter was just telling me that she bought some shoes while she was in Japan,
Yeah.
and I don't know. There's some cool brand of shoes that all the kids want. So she bought these shoes, and then she found out that she was trying to get a new pair, and she was trying to import them, and they were like $650 here for sneakers. And she's like, I'm not getting that. I'm like, yeah, you should sell your shoes. She had no interest in doing that.
That's a way to make money right there.
Yeah.
Yeah.
That's what you should do. You should go to Japan and buy just a whole bunch of shoes. Instead of bringing back beers, you should just do shoes.
50
Honestly,
kilos of
your
shoes.
trip.
Yeah.
It pays for your trip.
Yeah.
You know what? It just play the ARB. You know what? I'm gonna tell that to my kids.
Well,
see.
if they do go to Japan, you should tell them to buy some shoes because I believe that these shoes are super cool and that kids want them. I don't know. I have no clue. I know they're made out of kangaroos, which was a little bit like disconcerting. That I was like, really?
Kangaroos are like rats. They're like they
I guess so. Like
you can't get rid of those varmints. Rodents.
I don't know. Our buddy Rupert calls kangaroos deer that went to the gym, or sorry, deer that went to prison. Have you ever seen them? They're like
Just
yeah.
Well, yeah.
How about the one guy that got in a fight? The kangaroo was beating up his dog.
Oh, hold it! No, he had his dog in a chokehold.
Yeah.
and the guy goes and starts a boxing match with the fucking thing. That's hilarious.
Yeah, I can't believe these things. They're strange creatures. Like I've never been to Australia, and I think I would love it. I should go visit my buddy Rupert.
Oh, the Aussies are
yeah, and then like
great
the whole coast, like it's basically been in Malibu the whole way.
Vancouver is pretty much mostly Aussies during the ski season.
Well, no, you know what it is there, Patrick? A lot of times those kids, because they're part of the Commonwealth, they come and they can work here for a year or two really easily.
Yeah.
So you're absolutely right. And I remember when we used to go cat skiing all the time. We met some kids from Australia, and they were telling me why they came, and then they were like, they were saying like, we came for a year, and then we realized that you guys have the best weed in the world. Seriously, I'm telling you. And they're like, we're never leaving. And
well, if there's a reason to stay, that's clearly
nowadays there's weed everywhere, but back in like the 90s, like America was still putting people in jail for it and stuff, and we were much more lax about it. So people used to come and or early 2000s, and they'd be like, oh wow, like you'd go walk around and it smelled like Toronto does now. Have you noticed that, by the way? Do you think that Toronto smells more like more weed here?
Absolutely.
Yeah, 'cause like our buddy Rupert, the blind squirrel, he came here and he's like, can you send me out somewhere? I want to really feel what Toronto's like, he says to me. So I sent him to Queen West, and which is kind of like
it's like one big hot box. They just close it in, and it's just.
And he's like, he said to me, he said something to the effect. He says, I thought London had a lot of weed until I went to your city, and then I was like, everywhere there's weed, and it's like brutal. Like it's like, it's just absolutely everywhere. Anyways, so come here for the mountains, stay for the weed is basically going to be the new Canadian motto.
All right, boys.
All
I'm going to
right.
go.
Have a great week, everyone.
All right. Cheers, everyone.
Take care. Bye-bye.